Breaking news, the Bank of Canada has hiked interest rates to 4.75% as variable rate mortgage holders start to cry about their finances. This is the highest rate since 2007, right before the Great Recession. So what does that mean for the future? It's certainly an ominous sign. So Bank of Canada hikes another 25 basis points, bringing the rate to 4.75%. Let me show you this real quick. So I want to show you the Canada 5-year bond. This is essentially what the mortgage rate, the 5-year fixed mortgage rate is based upon. This is the most popular mortgage product in Canada. It has absolutely surged from a low of around 3.53 to 3.72, and the high, guys, for this bond was around October last year, and it was at 3.74%. So bond yields have absolutely surged on the back of this, and so has the FX rate as well. We had a gap up in the currency too, which I'll show you real quick. We'll see if this actually holds, though. It's going to be really interesting to see. So it gapped up after that news, as you can see right here, the Canadian dollar versus the US dollar, and now it's coming down. It's going to be really interesting to see what happens with that. I've been trading the Canadian dollar back and forth because it's been in this trading range, and it's going to be interesting to see whether this is a breakout now to the upside or it's going to be a false breakout. So we'll see what happens. I don't trade the breakouts. I lead that to the retail traders. In my opinion, it's just a fool's game. But we'll see what happens. Is this going to be a breakout or is it going to be a false breakout for the currency? So it's really, really interesting. I just can't believe how much bond yields have surged right now. And just to give you a quick update on the yield curve inversion, as you can tell by me laughing, it's not good. So you got the 1-year bond at 4.78%, and then you've got the 30-year at 3.25%. So, that is a huge, it's like 150 basis points of inversion in the yield curve right now. So that does not say good things about where the economy is headed. So let's see what else the Bank of Canada is saying, and we'll kind of go through what's going on with the variable rate mortgage holders because it looks really bad. So anyway, Bank of Canada, the increase brings central bank's benchmark rate to 4.75%, highest since 2007 before the Great Recession, like I said. Kind of an ominous sign that the central bank came off the sidelines on Wednesday after several indicators showed unexpected resilience in the Canadian economy in recent weeks. So let's head over to the Bank of Canada's rate statement right now and dive through what they said. We're not going to go through all of it because it's mostly BS in my opinion. Bank of Canada raises policy rate 25 basis points, continues quantitative tightening. So the QT is just continuing here, and that is really of note because that is taking liquidity away from the banking system. So all at a time when the banks really need it because they are in such a precarious place. So it's interesting that in this policy statement, they actually say about housing market activity that has picked up. Because you know why that's funny is because obviously there's been this spring market in the housing market. And, 25 basis points is really not a lot. But the increase in the market rates, the expectations have gone up massively. So, the market has actually took interest rates and it's risen them a lot further, especially like the 5-year bond, for example. So that is going to affect the housing market. We talked about the possibility of a bull trap, and it looks like this could be playing out in real time because you're going to have the economy falling apart by the end of the year, and you've literally got people out there in the housing market fighting the Bank of Canada, fighting the central bank. That's essentially what they're doing. They say don't fight the Fed in the US when it comes to financial markets, which is exactly what they've done right now, and they're continuing to do. And here in Canada, you have the same dynamic with the housing market. Don't fight the Bank of Canada, so it's really interesting that they mention that. So obviously, I think that that is a big part of what they've done. But it's also interesting because if you look at this, Bank of Canada is more worried than usual about debt loads. And this came out May 18th, so last month, not even 4 weeks ago, this came out. And, what's really interesting in here is they're noting about what's going on with the variable rate mortgages. The Bank of Canada says the amount will depend on the type of loan and when it renews, but it expects basically every mortgage to be at a higher rate within 3 years. So, what is that going to mean for a country where real wage growth has been absolutely destroyed? And it's hard to say. You'll have your opinion on this, and I'll have my opinion on this. But the CPI, as we know, is incredibly corrupt. But who creates the CPI? Who's producing the figures for the CPI? It's Statistics Canada. It's the government that is producing those statistics. So, of course, they want it to be manipulated and whatever. So if the Bank of Canada is forced to look at broken statistics, don't you expect that they'll then make broken decisions on the back of that? Because, they look at wage growth and they're comparing it with the CPI that the government puts out, which we just know is a load of garbage. It's the CP lie. So I think it's just kind of insane, when you look at these numbers. Variable rate with fluctuating payment 2022, 2023, it shows the amount of people that are going to be paying more. And then you've got the fixed payment variable rate loan, and then it shows the amount they're going to be paying more. I mean, those people are going to be paying 44% more by 2026. Guys, it's just not going to happen. And then you've got the short-term fixed loans. I mean, this is with their economic projections, right? They're probably projecting that they're going to be holding rates high next year. And who knows, that may be the case, but it's certainly not what the yield curve is predicting. And it's still got a massive inversion, 150 basis points. It's not predicting good things. And, the Bank of Canada also quoted the resilient economy, didn't they? They said how the economy was doing great. And if you look in here, they say right here, Canada's economy was stronger than expected in the first quarter of 2023 with GDP growth of 3.1%. Okay, but that is deflated using the CP lie, right? They are using the CP lie to deflate that number. So the number is wrong. Like, we are in a recession right now. But again, are you really to blame the Bank of Canada for that, or are you to blame the government? Because they're the ones that are feeding them all the broken statistics. It's not like the Bank of Canada can go, oh, you know what, government, we're going to start relying on the 1980s CPI again because it's more accurate than the one we have right now, which you've doctored and manipulated to your advantage so you can continuously deficit spend, get people into debt slavery so they become reliant on the government, so they become reliant on you. And that's exactly what's kind of happened. But it's interesting that they point to that GDP growth because, January is the most manipulated month when it comes to GDP numbers because of essentially the drop in the amount of GDP growth that happens and how they adjust all the numbers. It just means there's a ton more manipulation that goes on with the GDP numbers in January. So, there's a lot of manipulation in those numbers as well. And even if you're, like I say, adjusting them for the 1980 CPI, we've been in a recession right now. So I find it hilarious that they're sort of pointing to that and saying, yay, everything's great. And, when you look at household debt, as part of people's income here in Canada, I mean, again, it just doesn't look good. And I've got a banking video coming. In fact, I've got a few banking videos coming. So watch out for that. One of the Canadian banks stands out to me. There's been a massive anomaly in their earnings, which I'm going to show you. So a little bit of a cliffhanger that we can end on there, but it's really, really interesting. So, the credit market debt to disposable income being around 180%. That is just ridiculous, guys. It's just insane amounts of debt here in Canada. Interest rates are going up. Are they going to go up more? Leave your comments below. I was totally wrong on this one, and we'll see what happens. It's anybody's guess what's going to happen next. But by the end of the year, I think they'll be cutting rates, actually. If not Q1 next year, they'll be cutting. So it's going to be a major recession that's coming. That's what the yield curve is predicting. So anyway, if you've enjoyed this video here, you might like this playlist here. You might also like this video here, and I will see you in the next one. Take care of yourselves, guys. Bye-bye.